Jai Guruji, Shukrana Guruji. Welcome to this presentation where we'll evaluate the concept of alpha and factor-based investing, evaluating portfolio performance on return on Sharpe ratio. Here we'll evaluate the drawback of Sharpe ratio due to normality assumption, other portfolio measurement methods, conflict between criteria of return and Sharpe ratio, using the leverage concept to increase the return by maintaining the same Sharpe ratio. Concept and mathematical formula of Jenson's alpha, a linking of portfolio alpha to specific factors. Concept of factor investing in generating alpha, advantages and drawbacks of factor investing. Historical performance of market beta as a factor, commonly used factors in investing and metrics used to represent those. Broad methodology of factor investing, advantages of factor investing over Markovich mean variance portfolio optimization. I am Aninda Datta, the presenter. Now, what are the available other risk-adjusted portfolio performance measures not requiring normality of returns? We'll evaluate drawbacks of Sharpe ratio and the benefits of other methods. As Sharpe ratio considers standard deviation of portfolio returns as denominator, the plus minus 1 standard deviation would have different values of return dispersion if different portfolios have different return distribution. In normal distribution, plus minus 1 standard deviation covers 68% of cumulative probability. Thus, in the context of the Sharpe ratio, plus minus 1 standard deviation covers 68% of the total risk. That is 68% of the total dispersion of the mean return. However, if a return distribution has skew or kurtosis, then one standard deviation does not cover 68% of cumulative area. Example, a distribution with kurtosis has heavy tail, so plus minus 1 standard deviation has less than 68% of the total area. So while using Sharpe ratio on two portfolios, one having normal return distribution and another distribution having kurtosis, the total risk of second one would be understated, and hence the Sharpe ratio overstated compared to the first one. What are the other methods? Value at risk, non-parametric or historical VAR can be calculated without assuming any specific distribution. CVAR gives the expected loss in the worst case tail, especially useful in fat tail distributions. Omega ratio of probability weighted gains above a threshold to losses below it. It works on any distribution and captures the tail risk, so no assumption of normality is needed. Sortino ratio, formula, portfolio return minus target return divided by the downside deviation. Why it's better? Because it focuses only on the downside risk, unlike the Sharpe ratio, which uses total standard deviation, which assumes symmetry. Drawdown based matrix, maximum drawdown, measures the largest peak to show decline. Carmel ratio, annual return by maximum drawdown, doesn't rely on distribution assumptions, uses actual historical path of returns. Now, what is the main criteria of selecting an asset for investing? Return or Sharpe ratio. If one asset has higher return but lower Sharpe ratio, whereas another has lower return but higher Sharpe ratio. Now let's see the series table. Stock A has a lower cumulative return of 14.7% compared to stock B, which has a 21% cumulative return. However, stock A has lower standard deviation, so standard deviation of monthly return, so its Sharpe ratio is higher at 1.26 compared to stock B of 1.93. The table is depicted on this graph. This is the cumulative return of stock B. The cumulative return, the yearly return reaches up to 21%, but it fluctuates more. Whereas this is the stock A's return, cumulative return is less, but it fluctuates less. Stock A has lower return but higher Sharpe ratio. Stock B has higher return but lower Sharpe ratio. Now, which one an investor should choose depends on the risk tolerance. If the investor could borrow money at the lower rate than the asset's return, then return from investment could be increased by keeping the Sharpe ratio same. If the investor uses the same amount of own funds and borrowed funds, it is said to be 2 times leverage. So the return and volatility both could become 2 times, but the Sharpe ratio remains the same. Just say this is the cumulative return from stock B, which reaches up to 21%. This was the cumulative return from stock A. The cumulative return reaches up to 14.7%. Now this is the return from stock A if it is 2 times leveraged. That is, invested amount is equal to the borrowed amount. So the return becomes 2 times. Return and volatility both becomes 2 times, but the Sharpe ratio remains the same. This is the return from stock A if it is leveraged 3 times. So the return and volatility becomes 3 times, but the Sharpe ratio remains the same. However, if the asset return becomes negative, then the leveraged investment in that asset could multiply the loss. Therefore, leveraged investment should be preferably done on assets with higher Sharpe ratio. So that indicates low probability of return falling below the borrowing rate or below 0. Now let's evaluate how Jenson's alpha works. Jenson's alpha is used to determine the abnormal return of a security or a portfolio of securities over the theoretical expected return. If the theoretical expected return is derived from the CAPM methods, the expected return is based only on the systematic risk of a stock. Alpha equal to portfolio return minus risk-free return plus portfolio beta into market return minus risk-free return. So that is the return, actual return given by a stock over the expected return derived from the beta-based return. CAPM considers the stock return to be a function of only one factor, that is the systematic risk of a stock. As beta measures only the systematic risk, so the alpha calculated from CAPM based return measures the return both positive and negative generated by other factors and cannot be explained by beta. So this table shows the market return over a period of 7 years. The beta of the stock is 1.2 and the risk return is 4. Based on this, the CAPM gives a expected return of these given in this column, but the actual returns given by the stocks are given in this column. Now the table shows the expected stock returns over 7 periods based on CAPM formula, given the risk-free return, market returns and constant beta over the same period. So the x-axis is the CAPM based return, that is the expected return given by the CAPM formula, and axis y is the actual return. Now if the actual return is exactly equal to the CAPM based return, then we get this yellow line, which has a slope of 1 and intercept of 0. Now the yellow line connects the actual returns of if those are exactly equal to the expected returns, so the yellow line has slope of 1. The green dots represent the actual returns. These green dots are the actual returns, that is this column. The y-intercept of the green line is alpha of the stock. Here it is 2.29%. This y-intercept, this green line has a slope of 0.71 and the intercept is at 2.29%. So this 2.29 is the alpha of the stock. Now if portfolio alpha is calculated using CAPM, then it indicates some common factors other than beta are driving superior returns in the underlying assets. That is, the stocks having those factors are outperforming the market. A factor is a characteristic, so it could be considered a value or a risk, depending on whether the stocks exposed to that factor are underperforming or outperforming the market. If a portfolio gives high alpha but the underlying assets are highly correlated, then that may indicate the underlying assets are highly concentrated to one single factor and that factor has been rewarded by the market. Example, high exposure to one sector or to high momentum stocks. This presents a high downside risk if that factor underperforms the market. If a portfolio generates alpha but that underlying stocks have low correlation, then this generally indicates absence of concentrated exposure to any single factor. Thus, due to asset diversification in a portfolio, the company level risks disappear but factor level risks may remain. There are some broadly defined factors widely used, but those factors could be defined any suitable way. Generally, alpha driven by some common risk factors is short-lived, as most investors detect those factors and buy stocks having those common factors, leading to erosion of the advantage. Now, generating alpha increases the risk-adjusted return of a portfolio. Factor investing is one way of generating alpha, that is higher risk-adjusted returns. Factor investing is about selecting securities based on characteristics that are expected to drive returns on assets. Factors fall in two broad categories: risk factors, macroeconomic factors. Risk factors are value. It is undervalued stocks, momentum, size, quality, low volatility, and dividend yields. Single factor investing invests based on one factor, that is example value stocks only. Simple focused exposure, example a value ETF using profit by book value an ETF using price by book value ratios. Multi-factor investing combines several factors for diversification and consistency, example combined value plus quality plus momentum. There are two more main approaches: integrated, composite, blend scores into a single ranking. Stacked, filter one factor at a time. Example, first filter by value, then pick top momentum. Allocates capital to factors in a way that balances risk contribution, often used in quantitative or institutional strategies. Advantages of factor investing: evidence-based strategy. Factors like value, momentum, and size have shown long-term outperformance. Improved risk-adjusted return. Multi-factor portfolios can outperform the market with lower volatility. Helps target specific sources of return rather than broad market exposure. Drawback of factor investing: factors can underperform for long stretches. Example, value underperformed growth for over a decade. Data mining risk of overfitting to past performance. Crowding and diminished returns. Popular factors can become overcrowded, driving up valuations and eroding future returns. Market beta is the oldest known factor. It is given by the CAPM model. It is the extra return earned by taking on market risk compared to the risk-free investment. That is market return minus risk-free rate. As it is a risk factor, so sometimes market gives returns less than the risk-free interest. So market beta premium becomes negative, especially during the financial crisis and recessions. From the period 1928 to 2023, the distribution of annual market risk premium in the US market shows the following statistics. Mean 5 to 6% per year, median 7%, standard deviation around 20%. The distribution has fat tails showing extreme returns are more than what are predicted by a normal distribution. The distribution has slight left skew, not symmetric. That is, returns are lower than the mean. The returns lower than mean are more frequently than returns more than mean. In India, the mean market beta premium from 2010 to 2023 has been 8.24%. Source Professor Damodaran. However, the standard deviation has been higher and some years saw drawdown in excess of 40%. Now, breakdown of the common factors and metrics widely used to represent those factors. The value factor, selecting stocks having low market price relative to fundamentals. Common matrix, price to earnings, lower the better. Price to book value, lower the better. Price to sales, EV by EBITDA, free cash flow yield. Momentum factor, favored the stocks that performed well recently. Common matrix, 12 months total return, 6 months price return. Relative strength index, moving average across overs. Quality factors, targets financially healthy profitable companies. Common metrics, return on assets, return on equity, gross profitability, low variance in earnings, low debt to equity ratio. Size factors, emphasis is on smaller size as that offers better returns. Common metrics, market capitalization, lower the size, higher is the factor score. Lower volatility factors. Stocks with lower risks are given a higher factor score. Common matrix. Standard deviation of returns. Beta to the market. Downside deviation. Maximum drawdown. Growth factor. Companies with rapidly increasing revenue or profits are given higher factor score. Common matrix. Earnings growth rate. Revenue growth. Upward earning estimate upgrade. As the return generated by a market cannot be very accurately explained by one single factor of market beta, so Fama French developed a model by including two more factors to predict the expected return. The size factor explains the outperformance of small stocks compared to large cap stocks. Value factor, this explains the outperformance of value stocks over the growth stocks. That is low book to market value ratio. This is the Fama French model. These are the two additional factors included in the model. One is the small minus big size and is the coefficient of that factor. Another is the high minus low book value. So this is another factor. The model is based on the observation that small cap and value stocks tend to outperform the market over long term. CAPM gives a single variable regression, whereas Fama French gives a multiple variable regression. However, no factor works permanently and the factors driving superior returns change frequently. Example, sometimes high growth stocks perform better and sometimes high value stocks perform better. Thus, for generating sustainable alpha, the basis of stock selection needs to be changed as per the performing common factors. Unique common factor needs to be identified. Then the stocks in the index need to be assigned a score as per the presence of that factor. More the factor score of a stock, better is the score. If the chosen factor is outperforming the market, then the stock basket with higher factor score is bound to outperform the basket with a lower factor score. Higher the return spread between the two baskets, better is the factor working. A long short strategy could be worked out if the spread is high and the asset returns are uncorrelated. Thereafter, two more factors were added. Profitability, that is robust minus weak, and investment captures the return spread between the conservative and the aggressive investment strategies. Portfolio constructed with Markovitch mean variance optimization model with historical volatility and correlations as a major limitation, as real world volatility and correlations diverge from the historical values, thus creating model risk leading to poor and suboptimal performance. The factor models have lower model risk compared to Markovitch models. Markovitch optimization requires an n-into-n covariance matrix and a vector of expected returns for n assets. These inputs are notoriously unstable, especially the expected returns. Small changes can produce widely different weights. Whereas factor models such as Fama French, momentum, low volatility, value are rooted in empirical evidence and economic rationale, use simple and easy to understand linear mathematics. Instead of treating each asset individually, they group assets by common drivers of returns, reducing noise. Factor models have more robust out-of-sample performance. Mean variance portfolios based on sample estimation often fail out of sample due to estimation error. So this concludes this episode. More will be covered in the subsequent episodes. Have a good day. Jai Guruji, Shukrana Guruji.